Investments. Remember, saving money for the future is for your own future benefit. The earlier you start saving, the more you will benefit from it. Start saving today. Industry terms. Return is the growth that you will receive from your investment. Volatility is the up and down movement of an asset. Higher volatility is seen as negative. High volatility is large up and down movements for a period, while lower volatility is small movements compared to the large movements. An asset is the money that you have saved in an investment. Compound interest is the growth that you received on previous growth received. The investment horizon is the time you have to save. This includes the time you will be drawing an income. An investment is a vehicle where your money is expected to grow. We are going to discuss the four main asset classes used within an investment. These are money market, bonds, property, and equity. They are listed in order of volatility. In the following graph, volatility is explained visually. With the high volatility line, the movements are a lot more erratic than on the low volatility line. In the short term, volatility is high for equity investments. Thus, short-term investments must not be exposed to high volatility assets. If you have a short investment horizon, you want as little volatility as possible to ensure that you do not lose any investment value. But over the long term, investments like shares have more growth potential and volatility becomes less of a concern. Volatility should only be considered when you know your investment horizon. In summary, the shorter your investment horizon is, the lower your volatility on your investment should be. For a longer investment horizon, you can invest in more aggressive funds to get the highest growth potential. Money market. This investment is held in cash or short-term deposits, and has the lowest volatility but the highest liquidity. This is seen as the safest investment, but it also has the lowest return. Being in a money market for a long time can actually make you lose money due to inflation. Bonds. This investment is invested with a fixed percentage return and the cash is not liquid like money markets. These bonds are usually issued by governments or big corporations. The value of the asset is determined by the percentage return, the duration that the monies need to be invested in the bond, as well as the bond rating. Bond rating agencies give bond ratings from AAA to D, that is, best to worst, which also has an influence on the price of a bond. Property. With this investment, money is pooled to buy property. The value of the property investment is derived from the actual property value and the ability of the property to generate income. These property investment companies may also list on the JSE. Equity. This investment is a direct investment into a company by means of shares. A company uses shares to finance capital expenditures. The company sells shares to the public through the JSE in South Africa, and in return the public receives financial benefits out of the share. The actual share value can increase. The company can also distribute some of the income that it made during the financial period by means of a share dividend. All of this is taken into account when deriving the value of a share. This asset class is seen as the most volatile, but it also has the greatest potential for growth. There are other means of investing in companies, through private equity, but it is not widely used in our investments. Investments consist of the assets mentioned, and can be combinations of the assets, or a single asset class. There are several performance measures that can be looked at. Time horizon once again plays an important part. If a long time horizon is available, performance measures should also be measured across these periods. For instance, if you have a money market fund as well as an equity fund, the money market will have low volatility, but will only have a small return, whereas the equity fund will have high volatility. The return of the equity might be negative in the short term, but it is expected to have a higher return in the long term. The table below indicates the expected volatility and return of the respective investments over different time periods. Active investment strategies versus passive investment strategies. There seems to be an ongoing debate across the investment world about these strategies, and we will only discuss it shortly here. Active investment management. The investment manager actively manages the funds in the portfolio, buying and selling shares as he sees fit, using resources such as research, All of these trading activities cost money, and quite a few managers seem unable to outperform the market or an index of the market. A positive of active management is that a manager can sell assets that are expected to underperform and buy assets that are expected to outperform others. A negative of active management of your investments is the fees involved when buying or selling assets. The manager looks at the costs of buying and selling assets to make it worthwhile for the client. Passive investment management. This is where a manager passively tracks an index of a market, for instance the top 40 index, only buying or selling shares when the composition of the actual top 40 index changes. The passive investment strategy usually has low costs. A negative of the passive investment strategy is that if, for example, there is a company that is busy going bankrupt in the top 40, the whole investment will suffer the loss because it is tracking the index. Obviously, active managers that also bought these shares will also suffer the loss, whereas if the active manager did not own these shares, they would not have suffered the loss. We believe that there are positives and negatives to both investment strategies, and that a combination of both should be used to benefit the member most. Constraints to retirement funds. Retirement funds have certain constraints by law. These constraints are governed by Regulation 28. A short summary is: only 75% of the fund may invest in equities, no more than 15% may be invested in a single company. This is equities if the company has a market cap of more than 20 billion rand. This occurs on a sliding scale. A maximum of 30% may be invested in foreign investments, and an additional 10% may be invested in Africa. No more than 25% may be invested in property, both local and foreign. No more than 10% may be invested in commodities, both local and foreign. No more than 15% may be invested in hedge funds, private equity or other assets. Regulation 28 is set up in a way to protect the customer. It forces fund managers to diversify, that is, not keep all of their eggs in one basket. The eighth wonder of the world. Albert Einstein said, "Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it." Compound interest, in short, is gaining return on return from a previous period. This graph represents compound interest visually, and makes the following assumptions to show compound growth. Both investments receive an investment growth of 9%, which is a conservative view for an investment in historic perspective. Investment growth has a big impact on the compounding interest. With a normal growth strategy, we see a 100 Rand investment with growth being withdrawn at the end of each year. The line shows the total value the person receives, with the yearly withdrawals. With a compound growth strategy, there is an investment of 100 Rand that receives growth over the whole period and is compounded yearly. This graph shows that with an investment growth of 9%, the compound growth investment is double the normal growth investment value between year 19 and 20. This graph also shows that compounding creates exponential growth on the investment. The longer you are invested, the greater the effect of compounding interest.